Hey everyone, just want to give a quick update on markets. We've seen a lot of volatility since March 10th, which is the high on the continuous. So wanted to go through what our models have been showing going all the way back to the report we put out on March 11th, which was right near the high, kind of how our models have adjusted and the three things we've been really talking to clients about watching for through the balance of the summer. So what I'm showing now, it is the report we put out. This was as of March 11th, but as of March 7th settles. And we were a bit of an outlier at the time, saying that at the current price, I think the summer strip was trading around 465. And at that price, we were showing over a 4.1 end of season October. I realized we were a bit of an outlier at that point, but our models were saying the market was vastly oversupplied. Well, if we fast forward to now the report that went out with settles as of April 25th, we've actually seen our models have tightened very significantly. So the models as of March 7th were correctly identifying that oversupply, but over the last, that's 7 weeks, we've seen the summer strip sell off around $1.30. And over that time, our models are now showing fairly balanced. The problem that we're highlighting right now, though, is that the tightening in the front is actually not incentivizing enough production growth. And so that starts paint a pretty bullish picture as we head into winter with the growth in LNG. Now, that's kind of where we've been, where we are, and we were showing this tightness. This would have been as of April 25th that we were highlighting that things looked a little too tight. Since then, we've rebounded and rallied. It looks like about 45 cents as of right now. So as of the current price strip and the models we'll send out today, it's going to be a bit higher in this, and we'll see some loosening coming back in the market as we needed to see. Now, there are three kind of things I've been highlighting to clients over this time. The first is that we believe that 4.0 is a new 3.8. So 3.8 used to be a fairly neutral end of season. As you can see in October, right now, when we ended last October, we showed a 3.9 for the ending October inventory. Now, you see injections for the first 2 weeks of November. And so with those injections, you do see inventories get higher than that. But the 5-year average is somewhere around a 3.8 end of season for October. But we believe that 4.0 is the new kind of neutral standpoint. Now, why is that? You can look, we had a fairly normal winter, but in a normal winter, we saw the US would draw around 2.1 TCF, which is a larger draw than normal by about 100 BCF in what was a fairly normal weather winter. And that's primarily because of the large growth in LNG that we're seeing more and more structural demand. Another thing to kind of highlight is this past January, we saw the US set a record draw with right around a TCF draw for a single month, which is pretty phenomenal. Now, it was a very cold January, but that shows you what can happen in a fairly cold winter. And so with now the growing LNG, we're expecting larger and larger draws each summer, which is going to make the market will need to get closer to a 4 TCF instead of a 3.8 to get through winter. Now, what have we seen in the market over the last 10 years, and why is this the case? Well, over the last 10 years, the market's grown by 60%. So we've gone from about a 65 BCF a day market up to 105 BCF a day market. So that's a 60% growth. When we think about storage capacity, storage hasn't grown really in the last 10 years. So what that means is the market's ability to transport gas through time has actually diminished as a percentage of total market size. And so because of that, we have to utilize more and more of that 4 TCF roughly of US storage capacity. And so we're utilizing more storage capacity, even though it's a smaller percent of US market. So 4 TCF is kind of where my neutral number is right now. As I see estimates coming below that, then I would argue the market needs to loosen in order to fill completely heading into winter. Now, what we've seen to remedy the fact that storage hasn't grown over the last 10 years is we've seen producers functioning as synthetic storage. And you can see over the last year, what's happened is when the market was oversupplied last February, and we were producing around 106 BCF a day, the market took price down to around $1.50. And over the next 4 months, producers reduced production by about 7 BCF a day. Then markets around May and June rebounded as demand started to show up and production recovered. And then what you saw in November was as we got full, we got into November and there was a warm start to November and the cold didn't show up. And so prices dropped to $1.24 at Henry Hub, I think it was over the weekend of November 10th through the 12th. And over a period of around 14 days, producers curtailed 3 BCF a day of production into that weekend and then brought it back on almost immediately as that cold started to show up. So we're seeing, with lack of build out of storage capacity, we're seeing producers function as synthetic storage. Now, that points to another thing we're really watching for is we're watching for November. I expect it to be a fairly volatile month going forward. Because if we get to 4 TCF at the end of winter or at the end of October, then that means that if we have a slow start to winter, then producers or the market won't be able to inject any oversupply. If we have a slow start to November, we won't be able to inject that gas into the ground in November because we'll already be at tank tops. And so you'll have to see prices drop to incentivize curtailments because we won't have room in storage. Now, on the other side, let's say it's an early start to winter, because we need every bit of this 4 TCF to make it through winter and to have enough capacity to manage a cold Q1. Storage players will be hesitant to withdraw if winter shows up early. And so November will have to price up to Q1 premium prices in order to incentivize those withdrawals to roll forward. So because of that, essentially the market, in short, won't let November balance off of storage going forward. And so you'll have to see either a very normal weather November, or you're going to see a good bit of volatility as November is going to try to balance without storage. These are the things to watch for. If you're a client, you've already heard this. If you're not a client, maybe this is something new. But we'll continue to update you as things go forward. Thank you.